Hello. Welcome for another Wednesday Wisdom. And today we want to share with you a couple of things about the passive activity losses for tax reduction and how you can actually plan your passive activity losses to make sure that your tax deductions are relevant. So I want to talk about, there are a couple of traps here, and passive activity loss rules, and anyone who owns real estate, they know this is really bad news. And we can say, that it's a good thing. They're always, kind of trapping our money, trapping our losses, and we can't really use them. So we want to talk about a little bit at the buckets from a business perspective and how you actually have taxable activities, the cash that comes in. So, you have to remember that, in 1986, when this became law, right? It was very confusing to people, and it's still so many years down the line, it's still confusing to people for the passive activity losses. But one of the basic things that we need to understand, and we talked about the types of income many times. So one of the major element is you have to understand what kind of income do you have and what kind of bucket does it fill. So number one, you have a portfolio bucket. Right? In your portfolio bucket, you're going to put your stocks and bonds, right? That's going to be taxable in a different way than the other buckets. Number two, you have an active business bucket. That's for your, activities, the business activities that you have material participation in. So here, a lot of my real estate guys would argue with me, about the material participation. This is for if you're a real estate professional, you're going to fall into the active bucket, business bucket. And number three is going to be the passive loss bucket. Right? This is going to be applicable to your rentals and any other activity that you have in which you did not materially participate. Remember, I didn't say active. You did not materially participate. So let's say you're playing on the real estate, arena, and you have different types of income coming in. For the years that you have a real estate professional, you might have those activities as active business bucket, and all the other rentals that you have might fall into passive loss bucket. Now today, in this topic that I'm talking to you about today, is the trap that actually holds our losses captive in the passive loss bucket. So that's something that I want to make sure that we clarify, that all these years, after 38 years when the law was passed, we're still getting a lot of misunderstanding and confusion on this. So what I want to talk to you about, 3 escape cards, right? Like kind of get out of jail cards, from that trap of your losses in your real estate. So number one is you want to make sure that you keep your modified adjusted gross income below $100,000, and that allows you to deduct $25,000. It's not a whole lot, but it still, kind of frees up the first $25K of your losses. Right? The rest of the losses do not get lost. They actually get postponed for later on. They get a roll over as passive, losses accumulated over time. Right? So you want to make sure that if you go over $150,000, your loss actually becomes zero. It's null. You cannot take the loss anymore, right? It doesn't disappear. Like I said, it just carries over to the next year. So that's our first, kind of get out of jail card. The second escape that you can find is to change something in your operations. Make changes in your operations. So let's say if you and your spouse, or both of you, have a modified adjusted gross income that exceeds the threshold, like now you find yourself over $200,000, right? Or over 150. You need a different plan to maintain that immediate benefit from the rental property tax losses that you have. So you have to understand how the tax benefit dollars get trapped in the first place. And you have to remember that, to benefit from your rental property tax loss, you must, number one, either have passive income from other properties or other sources, or both qualify as a real estate professional and materially participate in the rental property. Okay, so one of the biggest pieces is that this is not lost. It's just, this is waiting. So let's give an example. I think so to kind of make a little bit more sense. So let's say your taxable income is $200,000 and you have only one rental property for simplicity. Say that the rental that you have produced $10,000 a year for the past 6 years, none of which you could take the deduction because you were over the threshold. right? So now you have accumulated $60,000 in tax deductions that are trapped in this passive loss bucket. They're not available to you for deduction against the income from the other buckets because you're an individual, okay? So now the $60,000 is not lost, it's just waiting, right? So I know it's sad that we can't use it, but there's some good news even in the bucket as a passive loss. So the 60,000 is not going to drown, and you can actually, it waits for you to give it an escape route, right? How are you going to get it out? So there's 4 ways you can get the cash out when you have accumulated passive losses in your rentals. Number 1, to generate passive income. So let's say now I buy another property that has income. Let's say I'm going to put this in Airbnb, or I'm going to do whatever. I don't have cost. I bought it cheap and a high rent. It generates passive income. Now I can offset this new passive income with my passive losses that have accumulated over time, right? That's good news. Number 2, you can change the character of the rental to non-passive. Okay. Number 3, you can actually change the status of that of a real estate professional and pass that material participation test for the property. That means, if you have, if you're, material participation, you don't fall into the passive loss rule. So the 25,000 limit does not apply to you, and you don't have the threshold anymore. Okay. And number 4, you can sell the property, right? Which we're going to go over in the last point that I want to make in here. So a lot of you would say, well, how do I change the character of the rental? Okay. So let me give you an example. Let's say you have, you own 100% of your rental and 100% of your business, and you now move your business into half of the rental. Okay. What that does is that 50% business use of this rental property now frees half of your trapped losses. So $30,000 get freed up. Okay, so this is really cool. And when you have self-rental, which is what I just explained to you, you can offset the losses in your business against the income that you generate while you use the property. You can even use 100%. You don't have to use just 50% for your business. So, the rules are more complex. I'm just going to keep it at this. Just keep in mind that when you have a self-rental, that means that you operate a business in your own building. You actually change the character of the rental, and you can offset the losses against the income that you generate in your business. So that's a really cool one, right? So the last, kind of get out of jail for the trapped losses that you have in your real estate could be a total disposition. Okay, so to release all the losses, you need to make absolute complete disposition. When you do that, 100% of everything that has accumulated becomes active. That means you can take all the losses. That can be really good when you have a large capital gain. That can be really good when you have a lot of recouped depreciation over time on a property. So it's really, really good. So what are the takeaways from you? The passive loss rules are really bad, right? It always traps something. You always have to think about it. Plan ahead. The passive loss rules, they need to be planned. You don't just go by and see, okay, what falls into my lap, I'm going to just take it in the year, because you might not fall in line with all the other income that you have, and you might have actually large losses being trapped for more than you want to have it trapped. So you want to make sure that, you want to keep it simple, and you want to make sure that you understand what kind of property, how you're participating in each one of them. And what you want to know is that the losses that are being trapped, they're not trapped forever. Majority of the losses can be recouped. You just have to look, what can you do in 2023 to release some of these losses that you've carried over. Let's say you have a large sale. Let's say you have some other things. You bring another property that can actually capture some of those losses and offset some other income. So be creative. If you don't have an accountant that actually talks to you about this, make sure you reach out to us. You can contact us at meetmycpapro.com and schedule a call so we can chat with you to see how can we help you plan those passive losses so you can take advantage in them the year that you actually need them. Thank you so much for watching, and I'll see you again next week for another Wednesday Wisdom. Thank you so much. Bye.